You may not like what I'm about to show you in this video because I'm going to show you exactly why home prices are so high and why they probably are going to stay that way for a while. To understand where we're at now, we need to take a look at where we've come from. Most of us can remember the 2008 housing crash. Housing prices were down nearly 30%, the stock market crashed almost 60%, and the unemployment rate hit double digits. It was the worst economic period that most of us have ever lived through. The collective net worth of American households reached roughly $66 trillion by the end of 2007, and the 2008 crash wiped out $11 trillion of that wealth, falling to $55 trillion by early 2009. But today, Americans are worth $154 trillion, and yes, that's netted out for debts. We've gained $100 trillion in wealth over the past 15 years. In fact, just since the first quarter of 2020, U.S. households have added $50 trillion in wealth. And that is a staggering amount of wealth created in a very short period of time. Of course, these wealth gains have not been evenly distributed. Clearly, the largest amount of wealth is controlled by the top 50%. But let's zoom in on that bottom 50% and take a closer look. While the stock market and overall net worth numbers bottomed in the first quarter of 2009, the net worth for the bottom 50% kept falling into 2011. The high was $1.5 trillion before the crash, and it plunged all the way to $236 billion by the first quarter of 2011. So the great financial crisis basically wiped out the bottom 50%. From there, it climbed all the way back to $1.9 trillion by early 2020, then went to another level during the pandemic, hitting a record high of more than $3.8 trillion. So the percentage increase for the bottom 50% has been higher than any of the other groups. But what does all of this have to do with home values? Well, the first thing we need to talk about is the wealth effect. When the market value of our financial assets is higher than we expected, we tend to not save as much as we did before. In other words, when we feel richer, we save less and spend more. This chart shows the growth in retail spending broken down by income group. The definitions for low, medium, and high income can vary widely depending upon the geographic area you might be looking at. But for this graph, low income is defined as under $60,000 a year, middle between $60,000 and $100,000, and high income is over $100,000. Notice that the spending increase for that high income group grew about twice as fast as the low income households. In other words, these high income households had more money to work with, and they spent a greater percentage of it. So in early 2020, when mortgage rates were at historic lows, and the work from home options allowed these high income households to live anywhere in the country, they went shopping for houses with the wealth effect mentality, and the pandemic housing boom was on. This mass spending spree drove up home prices all over the country. But there's another thing it did that is keeping those prices higher than they probably should be, and is probably going to keep them higher for longer. Do you remember the graph that showed the increase in household wealth for the bottom 50%? When we understand the single most important asset in determining personal wealth of this group is the primary residence, it's easy to see why the wealth of this group sank so low after the 2008 housing crash and increased so rapidly during the pandemic housing boom. So if the majority of your personal wealth is tied to the value of your home, and we saw home prices increase upwards of 70% in Austin, Texas, or Boise, Idaho, you're not only going to be feeling richer, but you're going to want to protect that value as best you can. The catch is you're not going to be able to realize that value until you sell the house. And it doesn't matter what the county appraiser says your house is worth, what Zillow says, or what your real estate agent says. The true value of your house is determined by what a buyer is willing to pay for it. And when someone tried to sell their home after mortgage rates began to rise in 2022, most of them were not able to sell it for what they thought it was worth. So instead of selling it for what the market said it was worth, it made more sense to hold on to it, because that unrealized capital gain made them feel richer. We are the victim of our own success. U.S. households have gained $100 trillion in wealth over the past 15 years. And just since early 2020, that wealth has increased by $50 trillion. This wealth has not been evenly distributed, but the lowest income households did see the highest percentage increase in personal wealth because they were virtually wiped out following the 2008 housing crash. And since a large percentage of the personal wealth is tied to their primary residence, a lot of those homeowners like the idea of feeling richer, and they are reluctant to take what they perceive as a loss by selling that house for what the market says it's worth. There are a lot of people out there who think lower mortgage rates are going to solve all this. But in this video, I'm going to show you why mortgage rates are probably not going to be enough.